Welcome back to my channel. Today we'll be talking about everything there is to know about fair value gaps. But first, let me explain to you what a fair value gap is. Let us consider this price run to have three bullish candles. The candle number 1, the highest price, and the lowest price of candle number 3. The gap between these two candles, which the second candle causes, is a fair value gap. So we are looking to trade, rather looking to spot this gap in price action. Now this gap can also be divided into three levels. The opening or the top of the gap is called an institutional order for entry drill. So if price comes down, taps this level and moves higher, that is called as an institutional order for entry drill, or an IOFED as an acronym for it. If price comes lower into the 50% level, it's called the consequent encroachment, and if it fills this gap, it's just a fair value gap filled. Usually when price is coming lower into this level, it is usually tapping this down close candle, which acts as an order block. This is the Euro USD chart on the 1 hour time frame. This is on 6th January 2025, and this is the 12 AM or midnight opening price. As you can see here, we have the candle 1, 2 and 3. Price returns into this gap, moves higher, does it again here, and expands higher aggressively. The gap here, as you notice, is not tapped. This is a breakaway gap. I will go into more details in a further video. This gap, which let's focus on this one, if I divide this gap, here we have the 50% or the consequent encroachment. As you can see, this was low before this aggressive price run higher. This is why the 50% level is very important. Now let's get into the two types of fair value gap: the buy side imbalance, sell side inefficiency, or known as BISI, and the sell side imbalance, buy side inefficiency, also known as SIBI. So basically, simply put, this is a bullish fair value gap where when price returns into it, you're expecting price to rebalance here and move higher. Similarly, in the bearish fair value gap, you're expecting price to move into this and lower. This candle, which is marked out as SIBI, should be an aggressive candle. It should have a very thick bodied candle, not one of those small ones. The same goes to this one. I'll show you with an example in the charts. Now let us analyze this price action, and I'll explain to you what a BISI and a SIBI is. As you can see here, price has taken an high, and this is a small gap. Rather, this would be a fair value gap. Right here, it did respect, but then it moved higher, right? This is a fair value gap. But this one is a sell side imbalance, buy side inefficiency, or SIBI. Notice this is a thick bodied candle, right? This is what I'm talking about. This is not a SIBI, okay? This is a SIBI. So this aggressive move or aggressive big candle is what you're looking for. These SIBIs tend to give you an institutional order for entry drill. This is for your notes, so do pay attention. The 50% level, when it's not breached, that is when you get these expansive moves. When it does, it is not so aggressive. Let us talk about the volume imbalance and the gap. So volume imbalance in price is when the bodies are not aligning next to one another like this one, but the wicks are. So you can see that the wicks lie on one on top of the other. So the highest price on this candle and the lowest price on this candle has an efficient delivery here, but the bodies have not. When you talk about just a gap in price, which is, by the way, the highest form of drawn liquidity in price. So when you notice a gap in price, which means that the highest price here and the lowest price here forms an actual gap in the market, price will gravitate towards this and not care for what price is going on here. Okay, it gravitates towards this. This is an actual gap. Let's look at Nasdaq on the 15-minute time frame on 27th October. As you can see here, price opened in a very bullish manner. We have a bearish fair value gap here, which price filled and then is consolidating. While everyone would expect price to go for this high, price came lower into this gap here. Why is that? That's because, as I mentioned before, an actual gap is the highest form of drawn liquidity. So whenever you have a gap, price will tend to gravitate towards here before it does here. The bullish array here, which was respected, which was a fair value gap, has been invalidated, rather closed below this here. This is a SIBI. Price gets into it. You have your opportunity here, targeting the gap. This is an inversion level. So every array can act as an inversion, meaning if price is bearish here and we have a SIBI right here, when price closes above the SIBI after it taps into a higher time frame key level, this gap acts as an inversion, meaning this was supposed to act as a resistance here, but when it closes above and invalidates it, this gap will act as support in price. So when price opens up the candle and comes here to the low of this gap, this will act as support and price closes up higher and moves higher. Now let us look at an example where we see these inversion levels play out. As you can notice, this is a fractal of a market maker sell model. We have a bullish fair value gap or a BISI. Once price closes below here, this gap acts as resistance. See it? Closes below, this will act as resistance. Goes up to the top of the gap, again lower, goes here, consequent encroachment or the 50% level, higher and then lower. Okay, if I add the 50% level to this, you can see here how the level has been respected. I've gone through more details on this fair value gap lecture in my other video, which I'll link in the description so you can check that out. Let us talk about balanced price ranges. A balanced price range occurs when you have a SIBI, but it is complemented here with a BISI. So you have a SIBI here and you have a BISI here. The SIBI is denoted by this yellow box and the BISI with these two lines, right? This has a clear, efficient delivery of price. So when price returns into this level, this is going to act as a brick wall where price will not be able to move below, but will tap this and move higher. Price is permitted to wick below this level, but not to close. Now let us look at an example of a balanced price range. As you can see here, we have a BISI, which is this gap, and we have a SIBI right here. Notice how price came and tapped this level, but it acted as a brick wall and price would not move higher and then aggressively broke down lower. If you're a beginner, I would highly recommend you to just focus on one array, which is the fair value gap, or the SIBI, which is just an aggressive fair value gap. Tape read these levels, see how price reacts to them, see how price is moving in accordance to the gaps. Watch for your liquidity pools, which would be the old highs and old lows, and combine market structure with this. So when you have these three things, liquidity, fair value gaps, and market structure, you will have everything you need. With a clear understanding of the market maker models or the power of three, whichever way is comfortable for you to read price, you'll be able to understand price at a professional level. That is all for the video today. I hope I could clear all your doubts regarding the different types of gaps in the markets. And like and subscribe to my channel for more content, and I'll be back soon.